Good evening, everyone. Thanks for jumping on this evening. I know all of you have busy schedules. My name is John Golden. I am the branch manager of Cetera Investors. And first, I'd like to say on behalf of our entire organization, the over 12,000 financial professionals from coast to coast, as well as the 3,000 employees and staffs that help our advisors grow their business, we'd like to just say thank you. We appreciate your business. We understand you have many different investment advisors to choose from, many different broker dealers. But the fact that you've chose our financial professionals here at Cetera Investors and our broker dealer, we appreciate your business. So tonight we have clients as well as guests on this webinar. I've been in the industry 40 years. I've sat through a lot of elections and people always ask the same questions. Well, tonight we're going to get those questions answered or give you more information. As you know, our team will probably do over 40 educational workshops in a year. So if you'd like to learn more about that, please reach out to your advisors on a personal note. But tonight we do have a special speaker. It's a great product partner of ours with Russell Investments. He's the director of strategists at Russell Investments. He's going to give you some insight and some information tonight that we feel you will find very helpful in giving up 40 minutes of your time this evening. What we'll ask you to do is throughout the presentation, there is a Q&A button. If you have any questions, please type those questions in the Q&A button. And at the end of the webinar, we will be more than happy. Shay will be more than happy to address that with you. So let me introduce Shay. Shay, thank you very much once again for all you do for us in our community. I'm going to turn it over to you, and it's your time.
Great. Thank you, John. And thanks, everyone, for being on the call this evening. It is an honor to be with you all and giving an update on the markets, the economy, and, of course, the hot topic du jour right now, which is the election. So before we get into it, let me see if I can actually share my screen. John, let me know how that looks.
Looks good, Shay. Excellent.
Okay, perfect. All right. So what I thought I'd do, our team here did a really good job of setting up, key slides that actually frames the elections. Not about, we want to keep it very apolitical, but really frames the conversation around elections related to the markets themselves. How influential are the elections to the actual outcome for markets and your portfolios? Obviously, for the purpose of this call, that's the most important thing. But before we actually get into the chart pack itself, I thought what I'd do is just take a couple minutes just to do a little bit of level setting in terms of where we think the U.S. economy is right now and where we believe, the economic cycle for the U.S. will be headed over the next, 12 months or so, right? And I think a good place to start is something that's being debated quite heavily right now in the financial media. I think for those of you that are, let's say, CNBC junkies or what have you, and are watching financial media all the time, there's a big, then those of you that are not, thank God for that. But those of you that are, and I'll admit, we're constantly watching the news flow, right, as it relates to the markets. There is a debate that's pretty prominent that's been going on for quite some time now, and it comes down to hard landing or soft landing. It's a phrasing that I'm sure many of you have heard about. And being debated on CNBC, Bloomberg, and even in print press as well, right? And effectively, what it comes down to is you've got certain set of folks that believe that the U.S. economy is downshifting, but not towards a recession, just going from really strong growth to maybe average, to maybe even below average growth, but not in the recessionary growth, right? So you're kind of going below trend, but not recessionary. And the U.S. economy will be okay. It's just a downshift that's taking place over the next 12 months or so. And then there's another camp that says, well, that downshift is only on path towards a recession, or what, aka a hard landing, right? And those are kind of the views that are battling it out right now. Where at Russell Investments, where we stand, is that we do believe that it's a narrow path, but we do think that there is a path for the U.S. economy to actually escape a recession over the next 12 to 18 months or so. We do think that the soft landing for now, based on the information that we have, is the baseline. That said, we know there is a downshifting clearly that's taking place in the economy. You won't see it actually in the GDP numbers. It's quite remarkable. Second quarter GDP growth was 3%. Third quarter GDP growth based on the Atlanta Fed GDP nowcast, which is the Atlanta Fed has a proxy for GDP growth. They're expecting third quarter to be maybe in the 2.5% to 3% range. So we're still talking about very solid growth. And to put that into context, for the trend growth, right? What is the expected growth in a normal environment for the U.S. economy based on productivity and population trend? It's around about 2%. So if we're going at 2.5% to 3%, that's above trend growth. So that's, really strong. So U.S. economy, at least the environment that it has been in and currently that we're in right now in terms of, the third quarter that just ended, is still looking pretty healthy. But we do expect things to downshift. And the reason for that is it's the labor market. We do see that the labor market is cooling. One way to a crude way to look at, to get that assessment is just looking at the unemployment rate, right? Where you've had the unemployment rate that was in January of 2023 was at 3.4%. Right now we're at 4.2%. 4.2 is nothing to be too alarmed about, but the trend is that it is gradually and slowly increasing. The pace of monthly job gains have been slowing, but it's still positive and it's still very decent. We'll get on Friday, we'll get a payroll number, so they'll give us some more information. But the bottom line is we're seeing a downshift and a slight increase on the unemployment rate, but we're not seeing a collapse in the employment backdrop. We're still seeing overall trends being fairly decent. So therefore, growth will be trending down over the course of the next 12 months, but not recessionary. So that's kind of our baseline view. And there are risks, of course, recession. I guess one last point I'll add is that there is, of course, risk. And if the unemployment rate and if the labor market really does downshift much more so than we expect, then the risks of a recession will increase. So that's something that we're keeping a very close eye on. And of course, the key to all of this is also, or one of the keys, is the Federal Reserve. We know that they've started to cut rates. They cut rates by 0.5%. The Chair Powell is, based on his most recent commentary, he's expecting, a couple of 25 basis point rate cuts over the course of the two meetings this year, as well as continuation of that. So policy is easing, allowing and facilitating an environment where the economy could downshift to a slower growth, but not recessionary. So that's sort of the big picture view, the way we see it, the Coles Notes versions of it at least. But then if that's the backdrop, how does the election factor in? And what will the election actually mean for portfolio outcomes, right? So let's get into the heart of the matter itself, and quickly go past the most important slide there and start with this, okay? So 60-40 portfolio. Look, at the end of the day, we're not investing in just equities or U.S. equities. We're usually investing in a balanced portfolio, a collection of stocks as well as a collection of bonds, right? 60% equity, 40% bonds. We're using that as a rough approximation or a proxy for a balanced portfolio. And what we're showing you here right off the bat is, okay, let's see how this balanced portfolio did in election years, going all the way back to Roosevelt Hoover in 1932, of course, to the most recent Biden-Trump in 2020. And what stands out, first of all, is if you look at the dotted line, what you'll notice is that the average portfolio return, a balanced portfolio return in an election year is 8.5%. I mean, that's quite remarkable, right? When the expectation is that, well, there has to be volatility, there has to be some downside risk, but on average, what we see is some years are obviously much better than others, but they've done quite all right. Now, let me quickly touch base on the three that really do stand out like a sore thumb. And one of those is, of course, 2008. The global financial crisis or the Great Recession. There's so many ways or qualifiers or descriptives for the 2007-2008 downturn because of the housing market, bubble bursting, if you will, the over-indebted household sector and what have you. That created a very sharp economic contraction, as we know, putting the pandemic aside, because that was kind of an exceptional and unusual environment. But that 2008 downturn was the worst economic downturn that we had since the Great Depression, right? You have to go all the way back to the 1930s. So considering that, yes, we did have a pretty big correction for a 60/40 portfolio, but that's the exception, not the rule. When you look at the other two instances, they're quite modest. 2000, you had the dot-com bubble bursting. We know there was a big, significant correction in stock markets where S&P actually was draw down, peak to trough, almost 50%. So that did create a challenging environment. Down 1% on a 60/40 portfolio is not too bad, right? That's where that 40% really did help you with that fixed income to just make it a much more manageable environment. And then other than that, you'd have to go all the way back to the 1940 election, and there was a 4% drawdown there for a 60/40, but also a very unique environment with kind of the World War II, as well as the Great Depression, right? Time frame around that era. So when you exclude those three, what you see is, an election year doesn't mean automatically that there could be volatility, but doesn't mean that it's going to be downside volatility. Well, what we'll show later on is really a lot of it ultimately depends on what the economy is going to do, which is why I kind of started the conversation with the economy and the backdrop, at least for this point in at this point in time, where the economy is looking okay. So let's move on. Now, a question often arises when we have these conversations is that, okay, that's great. That's, big picture 60/40, but let's dive a little bit deeper into the election cycle. And let's look at the totality of the government, right? In terms of the makeup of the government, who's in the White House, or which party is in the White House, as well as what's the makeup of Congress, and what are the various combinations, and what impact do those combinations have on market returns based on history. So that's what we're trying to show you here. And the initials that you'll notice is the first initial is effectively is highlighting which party was in the White House, right? That's the first one. The second one is which party was the majority in the Senate, and the third is, of course, which party was the majority in the House, right? So you get a sense of the different combinations there. So we've got all the different combinations that you kind of think of collectively or individually, and and again, pretty strong or data set here, because we're going all the way back. Oops, sorry, back to 1945, and what you'll see is on average, it's pretty darn good, right? Almost 13% average return. When you look at history of all the different combinations, right? Again, some will be better, some will be a little bit not as good as the average, but overall, they're all pretty positive and strongly so. The one that kind of stands out, and I'll touch on that and what that is, was the RDR, right, combination, with the average return being down 17%. So that's a big, that's a tough pill to swallow, clearly, with that combination. But that was, again, the exception, not the rule. And the reason for that is that was during the 2000 to 2008 timeframe under President George Bush. Now, we have to keep in mind it was such a unique set of circumstance that he found himself in, because in 2000, you come in, you have the dot-com bubble bursting. Then you have 2001, 9/11, the volatility that created. And then at the back end of his term, you've got the GFC, which we already discussed how challenging that was, right, in the prior slide. So it was, three strikes was really difficult, and that made it the challenging environment. But of course, that is the exception, not the rule, right? Those are the only two instances, because that was all under one president. When you kind of take that out, what you'll notice is that it is a pretty decent environment. Sometimes there's a lot of conversations about waves. Oh, what if there's a Republican wave? What if there's a Democratic wave? Well, waves actually do roughly in line with the average, right around 13%, or maybe slightly better than that. So the point here is that let's kind of fade the noise as it relates to the election, right? Keep your politics separate from your portfolio. That's the key takeaway when we look at this slide, and kind of the key takeaway when we look at most of the slides. Okay. This one is also an important slide, because it does get into some of the different policies that both candidates are currently discussing. So it's related to taxes, of course, and that's obviously a very hot and an important topic at this point in time. And the reason for that is, as we know, back in 2017. Then President Trump put in place the Tax Cuts and Jobs Act, which lowered tax rates. And right now you've got the former president who's talking about obviously extending them, or if anything, lowering the tax rates further, particularly for corporate tax, looking at bringing it down maybe from 21 to even down to 15% is a number that he's thrown out, and potentially even reducing individual tax rates as well, which of course we remember they went from 39 to 37 and now potentially could go lower. But even if they don't do anything, the point here is that the TCJA is set to expire in 2025. So if nothing is done, we do know that individual tax rates and certain stipulations will change and will be going up. Vice President Harris, of course, we know is talking a little bit different, where in the sense that she's more focused on corporate. She is thinking that she's discussing corporate tax rates actually going up, not back to where they were at 35%, right, before the TCJA, but towards 28% is the number that is currently being discussed. Let's see what it would be, but basically corporate tax rates would go up. And as far as individual tax rates, what she's talking about is for the upper income, they'd go up, but perhaps protecting the lower tax rates for the middle and lower income. So kind of different situation. But what this slide is actually getting at is that, taxes, again, hot topic, and obviously does have an impact on all of our pocketbooks, right, when we're talking about individual tax rates. But let's go to the videotape in terms of what impact does it actually have from a market perspective. And what we're showing you on the top panel are the tax rates. Again, great historical slide that the team put together, going all the way back from pre-depression to the current environment. And you have blue, which is the individual tax rates, corporate tax rates in red. And then in the gray there, you've got the long-term capital gains tax rates. And you can see they kind of ebb and flow. They were very high, pre-1980s, and they've been coming down gradually ever since. But here's the punchline. You look at the table on the bottom here, and we're highlighting, the gray bars are effectively highlighting environments where taxes rose, either one or a combination of all of them actually went up. And the exception is the 1931-32 tax hikes, right, which was done kind of right in the teeth of the Great Depression, which probably wasn't a smart idea, right? And we did see equity markets correct quite significantly, down nearly 28%. But with that being the exception, other than that, when tax rates were raised, the equity markets did just okay. And it kind of seems counterintuitive, but the logic, I guess, the way you can kind of explain it is that, historically, tax rates have gone up in an environment where the U.S. economy was in decent shape, right? There's a lesson to be learned from 31-32 that you don't raise taxes when the economy is recessionary or in a recession, right? So when tax rates have gone up, they've generally been in an environment where the economy and corporations are able to absorb those taxes. And as a result of that, the market, there could be some volatility around the news related to taxes, but all in all, the returns have been quite okay. So obviously, taxes are a hot topic. Let's see what happens, what the outcome is and what the tax rates will be. But as far as the markets are concerned, it's something to kind of look through from a volatility perspective. Okay, so this is a very interesting chart, and one of my favorites in the chart pack, because it does it discusses investor behavior, right? When election season comes along, your friends become frenemies sometimes, right? Given all the debates that are taking place, and you let sometimes your emotions impact your portfolios, your decision making in terms of your in terms of your investments, and that would be to the detriment of your longer term objectives, quite frankly. And that's what this slide is effectively trying to address. So what we're showing you here is we're looking at return and risk, right, for equities in different election cycles. So the pre-election year, the election year, the post-election year, and we also have the midterm election year as well. And what we wanted to do is get a sense that is there one environment, right, in terms of this election cycle that is better or worse from a risk as well as return perspective. And what you find is very marginal, right? Whether it's pre-election year, election year, or post-election year, which is kind of where we are right now, round about 11 to 12% return, not all that dissimilar. There isn't one that really sticks out like a sore thumb, like in some of the other exhibits that we show. And volatility is round about 14 to 15%. Again, pretty similar risk and return attributes, irrespective of the election cycle. So that would make the case or the argument there that, you know what, let's just stay disciplined and fade the noise, right? And just stay disciplined in your investment approach. But what the bottom panel here actually is highlighting is that investors aren't behaving in that way, because when you look at where is cash flow flowing before an election year and as well as in the election year, like we are right now, cash flow historically has gone more towards just cash instruments relative to equity instruments that happened and in a sizable amount, right? Pre-election year and election year. But then look what happens in the post-election year, and obviously even in the midterm election year, everything changes. The clouds have cleared, and what happens? Everyone is putting money back into the equity markets. But as the data here would suggest, returns are roughly the same. So when those that are actually using the election as a source of their personal anxiety and reflecting that in their portfolio decision making, they're leaving cash literally on the table, returns on the table, right? As a result of that. So staying disciplined is incredibly important. And this is where, just trusting your advisors is so important, because emotions can kind of get the worst of you at times. So another nice slide here where we kind of show what we've already displayed in terms of returns under different presidencies in a different light. And what we're showing here is growth of $100 for all the different presidential cycles, going all the way back once again to Roosevelt to President Biden. And what you'll notice is that once again, there is clearly volatility, right? As we know, that we actually just talked about the volatility numbers, right? So there is volatility in equities. We know that it kind of ebbs and flows. But generally it trends up, right? And by the end of the term, the returns tend to be positive. Once again, the exception is the Bush administration, as we just discussed, and this kind of visualizes that, right? Where the dot-com bubble and then the combination of 9/11, you had just a straight down. And then there was a significant and rapid recovery, but then you had the GFC, which is why we ended up being in the situation that we were in the prior slide, right? So this kind of visualizes that. But again, that's the exception, not the rule. Outside of that, you see that equity markets just tend to go up, albeit with volatility, but will go up. The other point I'll make is a few of these lines really just stand out, like Obama, Clinton, Reagan, and even Eisenhower to a certain degree. And they're much, their ascent is much more. That's simply because they were two-term presidents. Typically, if you're a two-term president, you have more time to accumulate, right? The benefits of compounding, and therefore the ascent is much steeper than the others. But it's not that they did something magical or what have you. So once again, staying disciplined and fade the volatility that comes through the election cycle. So this is also a very important slide because it kind of captures not only the elections, but quite unfortunately, all of the geopolitical events that are taking place. Obviously, we know there's there's a couple of wars going on in Europe and the Middle East, and there is a lot of tension related to that. So this slide, what I love about it, because it actually helps to contextualize not only, once again, the presidential cycles, which are on the bottom here, and it's a growth of a dollar chart for the S&P 500, but overlaying that, right, is the chronology of all the various kind of economic shocks, geopolitical shocks, healthcare issues, pandemics, epidemics, all these things that have occurred throughout the years. And what you'll notice is that, yes, it's not a straight line up. There is volatility. Clearly, there could be volatility when a lot of these things happen. But the point here is you look at the gray bars, right? The gray bars are actually recession. indicate when there was actually a recession. And it's typically when you see those gray bars is when you actually see a significant pullback in the equity market. So when we get concerned about that more significant, 5-10% corrections, that kind of stuff happens, right? That's kind of par for the course for equities. But we're talking about that 20, 25, 30, 40, 50%, those really steep drawdowns that occur. One, it the prerequisite, quite frankly, is that the U.S. economy is headed for a recession. And like we said, we don't think we're headed. If we are, it's going to be a mild one. So we wouldn't expect a severe pullback either. But of course, a recession does mean, but that's not kind of the course of that the economy is looking at right now. But the point is, it takes a recession to pull it back. And the more severe pullbacks are obviously when there were a lot more imbalances in the U.S. economy. And, for instance, again, that 2008 environment was one that really stands out because there was a lot of imbalance. Households were incredibly indebted, over leverage and what have you, right? Not the situation today. Household balance sheets are a lot cleaner. So if a recession did occur, if it's a mild recession, it's not something that would be so sinister as it was in times past. So the bottom line is that it really takes a recession for the market to really pull back. And there are events going on, and we don't want to be dismissive of them. But from a market perspective, those events will matter if they have an impact on the U.S. economy, right? And therefore, the implications of that will then be reflected in the markets. And so we want to keep an eye on, obviously, what's going on, if it's going to have a significant impact on oil prices, obviously that, but we're not there yet. And that's why the markets are kind of being a little bit volatile, but looking through the situation that we're facing right now. So we'll close with this slide, and this is sort of the fun slide as well, because we talk about, we put out a lot of data, a lot of facts in terms of numbers and returns and what have you. So we wanted to have a little bit fun with the election and wanted to see, well, what are different ways to kind of illustrate different indicators, right? That we could look at that, and what would those different indicators mean for market returns? So the first one, is football. Hey, football season is clearly in full swing. I'm in North Carolina right now, but I am originally from New Jersey. I'm a Jersey boy, and I grew up as a Jets fan, still a Jets fan. It's been very painful. I don't want to talk about that. That's a separate presentation onto itself. But we have some hope. Hopefully, things get going. But the reason I bring that up is because, if you are a football fan and you might be a Giants fan, I know we've got New York, a lot of New York, New Jersey folks. So, there could be this debate, Giants or Jets. But if you care about the markets, you might want to lean more towards the Jets or the AFC team, because historically, AFC team on average wins the Super Bowl. Returns are slightly better, 17-16. I'll take that as an AFC guy. I'll take that. Now, this is interesting. Even year or odd year, right? Which is better? And this one, there's no explanation, but for whatever reason, almost double the return in an odd year. And of course, we're in 2024. Next year is an odd year. So, hey, let's see how prescient this will be as it relates to that. Groundhog Day. Of course, every year, Groundhog Day comes around and everyone's, focuses in on it. Did it see its shadow? Did it not see its shadow? Well, what's interesting is, once again, if the groundhog sees its shadow, that's actually not a good environment for equities. But if it did not see its shadows, 20% return. And guess what? It did not see its shadow this year, and the markets are up around 21%. So the groundhog, people may criticize it and ridicule it in terms of what it means for spring and the weather that ultimately ensues. But hey, you know what, might be a good one for the groundhog as it relates to the market outlook, at least. And then finally, and perhaps probably the one that matters the most, the party in White House. Well, the median return, irrespective of Republican or Democrat, is 16%. I found this quite remarkable statistic, right? So once again, let's fade the noise, because there will be plenty of that over the coming month and a bit. But most important is to just stick to your plan, trust your advisors. So I'll pause there, John.
Thank you, Shay. If anybody has any questions, I don't see them in the Q&A. or Dom, if we went on mute lines, if anybody has a question or something they'd like to ask Jay, this would be your opportunity to do so. The silence is golden, as we say in my household. So if there are no questions, let me end with this. First, I just want to, again, thank all of our clients on this webinar. Several hundred people attend. And to our guests, thank you for your business. We appreciate your business. We know you have a lot of options. I'd also suggest to all of you, if you like educational workshops like this, as well as other topics, our team in Long Island next year will have over 40 different types of educational workshops and/or seminars, whether it's Social Security planning, retirement income distribution, long-term care, estate planning, tax distribution, to name as a few. If you'd like to be on that preferred list of advisors, please reach out to your financial professional and we will get you an invite to that. It is first come, first serve. Dom, are there two? It looks like there's two Q&As in there. I don't know. Can we see that?
Yeah, we have a couple. One of them, I think I'll have the advisor reach out specifically. And then one is, what's the opinion on the debt to GDP ratio?
Yeah, it's obviously a hot topic and one that comes up all the time as it relates to the U.S. fiscal outlook. First off, I'll just say this again. I'll be very apolitical about this. The based on the two parties, their platforms are slightly different, but at the end of the day, if you look at pluses and minuses depending on their different platforms, but both on balance add to the deficit. So from that perspective, they're very similar. So there isn't a whole lot of difference there. As it relates to the debt situation itself, right? The debt to GDP, it is high, and it is, look, let's put it this way: it is unsustainable if it stays on this trajectory indefinitely, right? It can't be sustained. The whole goal is not to take where the debt, so let's say the debt to GDP right now is hovering at around 100%. It's not to say that that needs to come down to like 60, 70% or so eminently. That's not the point. It's about debt sustainability. And debt sustainability ultimately comes down to the growth rate relative to the rate of interest that the government is paying. So ultimately, what matters is growth, right? You want nominal GDP to be ahead of your interest rate, so that starts to stabilize your deficits, right? And obviously, bringing the interest rate down also eventually ultimately lowers your interest payments over time as well. So the first step right now, and probably the most important one, is to make sure, and that's why the Fed bringing rates down is not only so crucial for the economy as it relates to stabilizing the employment situation, helping out some of the smaller companies that are probably more indebted and much more vulnerable to these higher rates than they have floating rate loans and what have you. But also bringing down the rate of interest is important to lower the debt burden for not just households, individuals, and businesses, but also for the government, quite frankly, and bringing rates down and keeping nominal GDP, right? So oftentimes when you're looking at the GDP numbers, it's real GDP, which adjusts for inflation, but the nominal GDP has to stay high, stay up. That's the goal. And nominal GDP, has also, we talk about growth being strong, nominal GDP has been holding up. And if we are headed in that soft landing, nominal GDP stays okay, and you've got the Fed cutting rates. That's how you start to stabilize that. But beyond that, and I'm not going to sugarcoat it. Policymakers aren't really talking about bringing debt levels down, and some of the tough decisions that need to be made. There's a window. The dollar is the world's reserve currency, so so the U.S. Government has a little bit of flexibility in terms of the timing, but the runway, every year that goes by, that runways get shorter. So over the next 5-10 years or so, it is something that politicians will have to really talk about much more directly amongst themselves, as well as with Americans.
Thanks, Shay. There's another question. What are your thoughts on possible taxing unrealized capital gains to the markets?
Yeah, there's a lot that often gets said, you know, on this at the stump, right? And you know, how many of the pledges can actually come to fruition is a question. And this has come up before, and in the past, I think just logistically, like I'm no kind of tax expert, but I do know that it is really challenging to um, keep an accounting of unrealized taxes and taxing unrealized gain and the implications of that. So you know, my personal view, I'll just say I think you can't assign a zero probability to anything these days. Gosh, we know that, but it would be a lower probability of that actually occurring, just because the logistics around administering that could be quite a nightmare, quite frankly. So let's fade the noise for now. We'll believe it when we see it. Let's put it that way.
Perfect, thank you. I do not see any other Q&As in there at this time. Okay, if there are no other questions, Shay, thank you very much. And folks, thank you for taking time out of your busy calendars to spend some time and get some great information. Because I'm sure you know, when you get great information, you'll make great decisions. Holidays are coming up. If I don't see each of you, please enjoy the holidays. Shay, thank you again, being a great partner with Russell Investments, as well as with Joe McNally and our team here and all of Cetera Investors. There's nothing else. Have a great evening, folks, and thank you for your time. Thank you, Shay.
Thank you. Thank you. Bye-bye.
Take care.